at the moment, we're still going through that transition part where technology is important, but eventually, in all cases, infrastructure becomes more important, more valuable.
From what we've seen, you draw us all the way back to Rockefeller, but you're going to see it with Google as well. They've ended up becoming infrastructure for everything.
And I was literally thinking about it. I think what's going to happen to these guys, they're going to get breaking apart. Like, it's like Max 7 is just accumulating like the value, power, the cash flow. That's exactly what happened to Rockefeller. At some point, he's like, dude, you're more like powerful than the government. So like, you got to break this business apart.
Mic check. Oh, welcome to EUVC Live at The Drop.
Powered
by Woven Capital.
So now we're going to talk to Rokas Pečiulaitis. Did I get that name somewhat correct?
I'm not going to question you on that. It's fine. It's a tough surname, right?
It is a very tough surname. On my phone, he's literally called Rokas P-I-C ... because I just gave up writing it. Rokas, we're going to talk about why the future, the tech of today is the infra of tomorrow. Tell me and tell everyone here today, first and foremost, why is this the case?
Firstly, thank you for inviting me and for doing this. I think a round of applause for every single thing that he's doing.
Thank you.
So I think that you clearly set the rules 10 minutes, so that's going to be a tough one for me as well, I think we chatted with Andreas and said, like, what's the interesting topic and what's controversial? There's nothing controversial. I think I get picked on having a firm called Contrarian Ventures, which is not that contrarian to invest in climate these days. So that is probably a question I get asked by entrepreneurs and also the LPs. But I think I thought about this topic that we discussed, and I wanted to pick like one historical example. And there's a lot of, like, we talk about the future, but like we rarely talk about the past. And there's a very cool company that was built in 1870s, which is called Standard Oil by a fellow named kind of Rockefeller, I think. And it's a good example of like what actually like technology of today means in the infrastructure of tomorrow, right? Because he actually, as a business, didn't build like an oil and gas business initially. He actually had a technology that was more efficient because it was more stable. He was producing at the time a commodity which was more stable. It was also cheaper, and then he figured out a way to sort of monetize of it. So he didn't go to like the gold rush of extracting oil. He actually went to refining oil, and then later sort of completely monopolized. So as people said, like, competition is for suckers. You want to be a monopoly, right? And I think what's kind of relevant to this like thought of technology of today becomes the infrastructure of tomorrow is that business was valued on infrastructure that it built, right? Like refinement, upstream, downstream, but it became valuable and survived for before the government sort of, I think from 80s, 70s to 1910s, it got disassembled into many different oil and gas companies that we know, which we're trying to, again, in this climate tech fight, trying to fight for a better alternative. It was running as a monopoly and is probably the most valuable company ever created by one of the more powerful gentlemen at that time. He won because he had a better technology, right? But he monetized on infrastructure and control of that infrastructure. So in a similar logic, what's happening today as we move from the last kind of 200 years of 150 years of fossil fuel to the kind of what's called energy transition into electron as a commodity of choice, primarily, as a greener alternative, as a more efficient alternative. We're sort of going through that transition that he went through. And at the moment, we're still going through that transition part where technology is important, but eventually, in all cases, infrastructure becomes more important, more valuable. And my thought in that was like that probably if we look at energy transition, what we invest as VCs, especially from a VC standpoint, because you have the whole stack, right? You have like the early stage investors, the growth investors, the kind of project finance, and then you have like infrastructure, and you get more serious and more closer to the banks, right? Happens to be that Rockefeller best friend was JP Morgan, right? So also a very fine institution. So I think what's interesting then is that we're backing technology, and sometimes the question to be asked, where a lot of like VCs and climate tech said, is a technology easy to monetize? Sure, we look at software businesses, but there are so different companies in climate tech, right? Software businesses, we all went vertical SaaS, right? Like we tried to rationalize it because it went to a certain industry and serve it. Happens to be very small TAMs and hard to monetize, even though solar business is 200 billion, but like selling software in solar business is probably 1-2 billion TAM. So my thought is like, I think probably 10% of money, I mean, this is an approximation, I don't remember, but I'm trying to guess it probably as a maybe good Pareto, maybe it's 20, 80, but but 80% is going to go to infra. And I think what we're trying to do, a lot of initiatives we do, is trying to bridge that vocabulary gap between going from that technology to infrastructure and the kind of capital journey that goes along it. And that's kind of very important for making this work. So that's kind of why I think this is a very important topic, that technology of today becomes infrastructure tomorrow, because if it doesn't, then technology failed.
So tell me, Rokas, how does it inform your investments? Is this a key model that you look for when you look at startups? You're saying, I want to invest in the startups that have a tech that has the potential to unlock an infrastructure of tomorrow?
Yeah, so I think this is very much not 10 minutes discussion, and doing it 10 minutes is probably, I'm going to try to do my own full games on it. But I think what I maybe learned for the last like 8 years since 2017 when I started investing is there's probably two things that I believe firmly, that if you have, everyone talks about in the software business product market fit, right? Like, so in climate tech, the problem was that everyone believed that there's a market and there's a product that you de-risk or technology de-risk, and then you have this product market fit. The problem is the market was fake in some cases because of a lot of green premiums and all the different things that we believe that there is a market, but there wasn't one. So when you have two things where take tech risk and market risk, like usually, as I joke with one of my fellows sitting next to me, is usually cemetery that you end up. So sort of you want to take one or the other, because if you take on both, it's like very hard, right? Like one itself, it's very hard. So what I started to believe, maybe I'm still trying to, investing in 7 years is not a long time investing. I think you have to invest like Ray Dalio for 40 years to believe that you start to scratch surface of something. But one thing that I believe is climate tech is a veg to something, and the business model question becomes how you monetize it. So maybe let's go, we also discussed there. So you go into a supply chain business, and then let's say I'm going to go and build a business serving pulp and paper industry. Like pulp and paper industry is very consolidated and concentrated, like many other industries, like food industry, like agriculture industry, like food. There's like a couple of companies that own everything. There's in agriculture, there's Cargill and there's Louis Dreyfus that own everything. Like mostly these are commodity trading houses, by the way. A good book to read is actually Waldo's First Sale. I think it's one of the best books to understand like the transition, where it's starting and where we're kind of going, who kind of owns the market itself. It's about the commodity traders, which are still very powerful in organizations. But where I'm going with this is like when you have a veg, so you create, there's a lot of chaos and complexity. I love the presentation that was done before. In that chaos, you go to solve a problem, and most likely you'll give away that solution for free. So you don't build a vertical SaaS company. You get a veg into it. So you start serving, for example, pulp paper industry. It's very consolidated. There's like a company called Suzano and Klabin in Brazil. Happens to be that they do 40 billion top line. Let's say you solve a one problem there for them, and the trade that happens between all the clients that they serve is around 40 billion for them alone. What if you take a take rate on that payments business and insurance business, and suddenly you have like a very valuable business that has a moat, they serves it, they deeper integrates, and happens to be that they spend a lot of money on SAP and various other things that maybe they should not spend money on. So that's a veg into a market that is underserved, that is not efficient. You solve a problem, you give it away for free. That's how your lock-in happens, and then you monetize on. The other one is probably like what a lot of like very successful businesses do. You become fully integrated and vertically integrated, and you kind of own the whole thing, and then you make it, as Rockefeller did, cheaper, better, and more efficient, and upsell. Then it's a great business. Like Amazon did it perfectly, and there's other companies that can take like reinvent the bus, how you ride a bus into a city, or how you do other things as a service that is cheaper, better, and it's electric and green first. So I think these two, I believe, the veg and the kind of fully vertical. The rest is sort of, it's going to be very choppy before you find that true product market fit, unless you're serving the market that truly exists and you're serving a problem. But then there has to be a real technological reason why you're better, and that's where it starts with. But then you need to scale, and I think the kind of there's many cool books written about speed and scale, and that much matters. Speed is obviously can sometimes you reinforce it or not reinforce it, but scale is what matters ultimately to build a big business. At least that is venture-like returns. So I think those are the two kind of business models where I think business model being very important. And I think one takeaway is probably you don't want to take two of those risks, either product or market.
I think what you're saying, Rokas, is a great abstraction. You from what we've seen, you draw us all the way back to Rockefeller, but you're going to see it with Google as well. They've ended up becoming infrastructure for everything.
And I was literally thinking about it. I think what is going to happen to these guys, they're going to get breaking apart. like it's like Max 7 is just accumulating like the value, power, the cash flow. That's exactly what happened to Rockefeller. At some point, he's like, dude, you're more like powerful than the government, so like you gotta break this business apart.
Yeah.
Which we saw kind of.
They were just about to, and
Yeah,
then AI
exactly.
came and
Oh, like
blew
Google
up a
Chrome is
little
still
bit.
questionably maybe not gonna happen now, but yeah.
Let me ask you one question in this connection. Let me say one thing, because the reason why I asked this question is because what you're describing here as a thesis is very similar to what I thought when I listened to the A16Z podcast, where they covered their investment in Adam Newman, where
Yeah.
I realized that this investment in Adam Newman's new company Flow was actually much more than a venture investment. They invested in some tech, but as you kind of said, that was the wedge. But they are also doing a bunch of real estate investments. They're spinning up new funds that they, of course, then have some type of economics on to build the huge buildings, real estate buildings in everywhere across the world. So it made me think that A16Z is doing a big play here, because they're using their tech investment side to enable them to do a huge land grab in real estate. And
Yep.
I kind of go the same way here. So if you're Rokas Pečiulaitis something, sitting here and using Contrarian to come into a company that does whatever in climate tech,
Yep.
do you then also raise a much bigger fund to follow on and do the infrastructure investments?
It's a good question. I think there's different flavors to play venture, right? I think there's people that choose geographies to play on their advantage. There's people that select sectors like we do to play at advantage, maybe knowledge, maybe access, maybe, I don't know, whatever makes you different. I do believe that there's a cyclicality investing, being a vertically focused fund, like we're kind of experiencing now, right? Like the AI, there's something always new in technology, like business overall. And I think, climate tech was like a big running topic for the last couple of years. I think in that thesis, kind of where we started the discussion, the technology of today becomes infrastructure of tomorrow. When we start investing in technology in a novel, like sort of beginning of cycle, which the previous cycle wasn't oil and gas, right? The previous cycle was solar and batteries and a lot of things that we de-risk, like wind. And that paved ways for other things that we can do now. There's a lot of software being sold in these businesses, but you need to deploy that infrastructure. Like, so no one, a lot of people don't remember Cylindra, but like, that was a business that went to top basically, and that was a business that basically was the kind of start of Americans being dominating the solar industry, but it never happened. Chinese kind of took over that technology and made it scalable and cheaper and better, and so we deployed that infrastructure made by them, and they captured the most of the value, to be honest. And that's the reason why China where it is today, right? Like, they captured a lot of value by like taking technology that was never monetized as a technology because it had to be produced and sold as a product. So I think from my standpoint, how I think about it, it makes absolute logical sense if I invest in a breakout technology that produces, for example, a sustainable aviation fuel, and I go through that like really painful descaling process of making that technology successful or economically feasible or competitive or better. I should monetize on deploying that infrastructure and project finance through equity, because that's how really big asset managers were built. To your point of real estate, right? Like a lot of the big, and again, it's about incentives, right? So like a bigger funds, they care to back a platform through which they can deploy billions of other dollars, right? Because that's your business, right? You wanna enter something new, own it, guide it in a certain direction, deploy a lot of it and scale it. And that scaling usually comes not for technology, but for adoption, and especially in the energy transition of implementation and deploying assets. So that totally makes sense. I think the bridge gap of where we are, especially we're talking just about energy transition, is the traditional infrastructure funds would not touch technologies because we call them first of a kind. And there was a great speaker, Bill, yesterday, who said, like, you go to banks to finance infrastructure and you call it first of a kind. Are you crazy? Like, banks don't want to hear first. Like, they want like stable, like actually is gonna work. Like, why do you invent this like crazy terminology where like you scare people off, you know? So I kind of like, I was like, that's actually a good point. And so my point is, like, there's this middle gap of, like, a lot of people talk about growth being the middle gap. I don't believe there's a growth middle gap. I actually believe there's emerging infrastructure growth middle gap. Because growth, like, if it's a good business, like, generalists will invest. There's plenty of growth capital out there. The problem is a lot of them are not great businesses, and they're being funded with equity, which you shouldn't do. because it's not the most cheapest capital you can acquire to scale a hardware business, right? So you want the project finance to work. You want the capital stack to work, and that capital stack to evolve as you grow as a business, or you scale it as a business, or you de-risk it from a technological standpoint, and eventually, hopefully, the market evolves. So you go from that no product or technology risk and no market to eventually collide into that perfect, equilibrium of call, like where risk is de-risked to a level and the market has evolved, and then there's the scaling journey where you have like the profits of macroeconomic curves colliding, and like beauty happens. And so I think that's important. And I think a lot of these technologies, I love Bill Gates saying like we overestimate 5 years, we underestimate 10 years. That's kind of exactly what's going on. Like transition don't happen in like 5 years. Let's be like realistic. Like it took like oil and gas industry 50 years to get to like efficient drilling. I mean, what we're talking about, like, so it takes like 20 years and 30 years. And I think that's cool about this industry is a lot of people are not doing it for like the quick thing. I think the people that really do this, they do it for, because if you get it right, this is like really like detrimental and impactful, and it changes like historically even the course of how like we operate as economies and human beings.
Rokas, thank you so much.
Thank you. Thanks for that.